Hello, everybody. Julie Perry here with Brian Perry, Perry Home Solutions, helping people buy and sell real estate in Palm Beach County, Florida. And today we have Brian discuss some interesting topics. I think a lot of people have will find this interesting is taxes. Not taxes that are interesting, but maybe some ways to save on taxes and things that affect real estate and taxes. So
Yes.
that'll be interesting.
Okay.
So what would you talk about today?
So taxes, yes, because we're basically in tax season here. So this will be a good thing. Okay, a couple quick things. Number one, which we get a ton of questions on this one, right, is capital gains taxes when you sell real estate. Mm-hmm. In other words, are you going to have to pay taxes when you sell your real estate, and how much, so on and so forth. Disclaimer up front, I'm not an accountant. Are you an accountant?
Nope.
We're neither one of us are accountants, and this is not tax advice. Seek advice from an expert professional tax person.
Right.
Okay. Capital gains taxes, couple quick things. Number one, home sales can be subject to capital gains taxes. Okay. We're going to talk about how you can avoid them or limit them.
Right.
Okay. So number one, capital gains tax applies when you sell a home that you paid for, and the amount that you can be excluded from taxation is $250,000 if you're single and $500,000 if you're married.
And filing jointly.
When do capital gains taxes apply on a home sale? When do you pay it?
Right.
When the home wasn't your principal residence?
Right. So when should you definitely expect to pay capital gains taxes?
Right. Yeah.
Right. Mm-hmm.
Yeah. Well, exactly correct. Okay. No. I'm the one that read this and I forgot what that said. Okay. When the home was not your primary residence, you will pay taxes. Mm-hmm. Okay. When you've owned the home for fewer than 2 years, you could be subject to the taxes. When you didn't live in the house for at least 2 of the last 5 years, you could be subject to taxes. Mm-hmm. If you've already claimed the home sale capital gains exclusion on another property within some level of a 2-year period, you may not be able to claim it again within a similar period, okay?
Right.
Another thing, you bought a house through a like-kind exchange. I'm not going to talk about that. That's a different video that we've already done. It's called 1031.
1031 exchange. Go look it up.
And if you're subject to expatriate tax, which is something to do with your citizenship in the United States, okay?
You move to another country.
I'm not going to get into that because I'm not a international citizenship lawyer, so we're not going to talk about that. Okay, calculating capital gains. So the first question I get, will I be subject to capital gains? Well, you need to pay attention to what we're saying there and talk to your tax advisor and determine if those things affect you, okay? Number two, how much will I have to pay? And again, we're not going to get in grave detail here, but we're going to give you a summary, and if you have more questions, you can call us, and we're happy to answer them. So profit is generally defined as the difference between how much you paid for the home and how much you sold it for. Mm-hmm. Generally speaking, that's what you're going to be subject to taxation on. Mm-hmm. There's a couple of caveats to that. Now, the first thing you should consider when trying to figure this stuff out is, are you going to be subject to short-term capital gains taxes or long-term capital gains taxes?
That's definitely a question for your accountant.
I'm not going to talk about that. Okay, that's an accountant question. Now, if you're exempt, then that won't matter, right? If you're not exempt and you will be subject to the taxes, that will be a good question to ask your accountant.
Right.
Okay, here's the key. How to avoid capital gains tax on real estate. Okay, this is the real juice here. Number one, live in the house for at least 2 years. Number two, see whether you qualify for an exemption. That's a good one. That's a good tip.
As the IRS.
If you have a taxable gain on the sale of your home, you might still be able to exclude some of it if you sold the house because of work, health, or unforeseeable event. So that's a real key here. And that's a complex accountant level question, mm-hmm. because there are instances where you may not get the capital gains exemption, but you could still get it because of additional circumstances. Mm-hmm. So that's a really important little note. Write that one down. That's a little key tidbit of this video, okay? Number three, keep your receipts from home improvements. Mm-hmm. The cost basis of your home typically includes what you paid to purchase it, as well as the improvements you've made. When your cost basis is higher, your exposure to capital gains taxes may be lower. Remodels, expansions, fences, driveways, air conditioners, they all are examples of things that you might cut your capital gains tax with.
Right.
Final thing on capital gains. Is there a 55 and older exemption just for that category of people? And the answer is no, there is not.
There used to be, apparently.
There used to be, yes. That's it. That's the whole thing. So keep these items in mind when you're selling a piece of real estate. Oftentimes people come to me and they're worried about the taxes that they may be exposed to. And in many cases, they're not exposed to any. But you got to be careful because there's a lot of rules.